think of the financial markets as very much part of the modern world, but they've been around for much longer than you might think. Investors have reams of historical data at their disposal, yet they tend to base their decisions on very recent data and assume that a fund that has performed well over, say, the last 3 years will continue to perform well in the future.
The first problem investors have is collecting a large enough sample size so that they can characterize the risk and return of an investment. Now, how large of sample you need is tied to how variable the data is, okay? And we have stock market returns with 20% standard deviations. That's very large from a statistical point of view. So preferably, we'd like to see at least 30 years, but my preference is even 50 years, and most academics want to see the whole 87 years of data before they would start making generalizations or estimations about the expected returns or even the volatility of stock market returns.
In the 5-year period from 2013 to 2017, the S&P 500 index had an annualized return of 15.79%. Based on that return, many investors would conclude that the S&P 500 was a shoot-out-the-lights investment. However, for the 20-year period ending 2017, the annualized return was much lower at 7.20%. For the 50-year period ending 2017, it returned 10.12%. There are times when investing is like riding a roller coaster. History is littered with examples of market crashes, the biggest of which came in 1929. Now, this is the ticker tape from the day of the stock market crash in November 1929. And in those days, trading volumes were so low that you'd get about 3 or 4 listings every hour. But this represents the first 45 minutes of trading on that day. Later that day, a broker from Boston fished this ticker tape from out of the trash because he realized that this was a very significant day in history. He framed it and he put it on the wall of his brokers in Boston just to remind himself and his colleagues that crashes like this, really severe crashes, do happen. But despite such crashes, the financial markets have almost always rewarded patient investors. The most complete historical database for stocks, bonds and mutual funds can be found at the Centre for Research in Security Prices, or CRISP, based at the Booth School of Business at the University of Chicago. It provides data from 1928 to the present day. This graph shows the growth of a dollar in various indexes over the course of 90 years. During that period, there have been some very major news events. While it's true that those events did have big, short-term impacts on market prices, they proved to be largely inconsequential in the long term as the market marched ahead. Despite several setbacks, capitalism has not only persevered, but thrived.
Depending on where you start a monthly return series, you can get very different results. If I look at results from January to December, I can see one kind of return, but if I shift that even 1 month, you can get a very different return. When you look at data on a monthly rolling basis, you're in essence capturing a simulated passive investor experience.
The information contained in monthly rolling data is far more detailed than yearly data. For example, in a 50-year period, there are 589 rolling 12-month periods as opposed to 50 consecutive non-overlapping 12-month periods. This table charts the comparative performance of different equity indexes from 1928 through 2017. It shows that over 1,069 one-year monthly rolling periods, a simulated passive investor in a large growth index beat a simulated passive investor in a large value index 45% of the time, causing investors to think it might be a toss-up between large growth and large value. But in 841 20-year monthly rolling periods, the large value index beat the large growth index 89% of the time. Over short periods, volatility and price swings confuse investors as to which indexes are better long-term investments. but the picture becomes clearer when longer periods are considered. So, studying market history helps investors to understand the risks and returns associated with different asset classes. It helps them to build an asset allocation appropriate to their risk profile. It also equips them with the knowledge needed to withstand short-term market volatility.